according to the latest statistics from the Australian Bureau or Taxation Office, the ATO, residential property investors claimed a total average depreciation deduction of, listen to this, $3,748. That was during the 2016-17 financial year. Now, by comparison, the experts at BMT Tax Depreciation found for their clients who had residential property investments an average deduction of $8,845. That's the difference of $5,000. Joining me to talk about this and the stats behind all that, Brad Beer from BMT Tax Depreciation. G'day, Brad.
Hey, Kevin. How you doing?
Fantastic, my friend. I want to dig into those stats, and we'll talk through your tips on how investors can get more. But before I do, it just seems to me that a large portion of property investors are really missing out on some very significant deductions, Brad.
Yeah, look, we crunch these numbers each time the ATO brings out these figures, and we actually run our numbers across all of the schedules that we've done and the claims for those year. Now, the comparison is not quite perfect because of some of the way the ATO data comes out, but it's, there's definitely some similarity to the amount of lost deductions there, and the numbers that we claim by just really, or we help people to claim by making sure it's done properly, because there's so many, just like just about every day of my life, I would speak to someone that says, "Oh, I didn't realise you could do it on an old property," or "Doesn't my accountant just look after that?" And then we go, "Well, you realise you could be doing it this way," and there's usually more deductions in those things because they haven't really. And it's just simple; they haven't gone and done that piece the right way.
Yeah, it's staggering, that difference. That's well and truly more than double. What else did when you analysed those 16, 17 ATO statistics, what else did you find out about the average property investor?
So I've got a few stats here. We've got about 3 million investors that claim deductions, and we'll talk lots about deductions, I suppose, because that's where we've a little bit up. So the last figures before that are in the 15-16 financial year, up 3%, 3.3% on the previous figures. It also showed that about 64% of property investors that made these deductions have an income of under $80,000. So it's only the high income earners that take advantage of these deductions is not quite right. And there's only about 7% that earn more than $180,000 or in the top marginal tax rate. Also says that there's 71.2% of investors own only one property, and another 18.9% of those own one or two, and only 1.8% of property investors own more than 4 investment properties. And our data's are fairly similar in respect to, I think ours is slightly higher with only one. Well, it's one depreciation schedule, not one investment property, because sometimes they may have another one that may have already been done or something else. So our data's got some similarities to that. It also says that people in my age group and beyond own a fair bit of it. 24% are Generation X's, 24.9%, and in total there's 73.7% are over 40. So I'm in that category. And 48.8% are the baby boomers. So a lot of the people have owned properties for a fair bit of time, or they're in that age bracket, I guess. And you've got to grow some equity to get to the ability to do that often, to be able to buy in and get in and buy some investment properties. And it's a bit tough to start sometimes with the cost of housing.
Yeah, indeed. There are two types of depreciation available, aren't there, in a residential property? I wonder if we could just explain about those.
Yeah, look, we blanket call it depreciation all the time, but it's actually got two areas. And one is what's known as, capital works deduction, Division 43 deduction. And it's a deduction that's made on the structure of the building, concrete floors, walls, roof, bricks and mortar, your kitchen cupboards, basins, toilet bowls, etc. Things that seem to last a long time, which is sort of said to be 40 years, I suppose, because that's the life we kind of claim them over, is one section of the claims that we get to make. And the other part of the claims that you make against property, or the other part of depreciation, which is the one that's actually called depreciation as opposed to capital works deductions, is what's claimed under Division 40, which is plant and equipment, which are things like carpets, air conditioners, blinds, stoves, curtains, things that last not as long. The tax office allows us to claim those things quicker, and that's based on the sort of the effective life that they think that the things are going to last. Now, the ATO also has some statistics on what the claims are, not just in total, but they split it between these two types of claims. And there's about 1.46 million people claimed capital works deductions, with an average of about $2,385 each. And there's about 2.11 million at an average of $1,360 each, $1,363 actually, have made plant and equipment deductions. So there's a few more people making plant and equipment deductions than there is making deductions for that building allowance. And the reason for that is that the building allowance actually has a date that it needs to be built after in order to claim that. So some properties don't qualify for that claim. Some of the difference in those deductions, and also, I guess, the number of people claiming those. Now, we've got so the total then actually adds up to that $3,748 per year, and we've assessed our numbers for that year, and they were over that $8,000, which is obviously a substantial difference.
Yeah, I'm going to ask you in a moment for your top 3 tips for investors. Before I do that, these numbers that we're talking about, how do they compare with previous statistics reported by the ATO?
Yeah, so in analysing and looking at the 16-17 versus the 15-16 financial year, the number of investors claiming that capital works was up by 86,000 people. So there's more people claiming Division 43, 86,000 of them, up from the 1.3 million. So that's an increase. And I guess some more people have bought investment properties, new properties entered the market and been bought by investors. So that's up by a bit. And the plant and equipment's up by a little bit less, 67,000 people compared to the previous numbers. Now, also with some of those changes that happened a couple of years ago to depreciation, that'll mean that there'll be a few less people claiming this plant and equipment because there'll be some deductions. And look, the average claimed by the investors is up slightly. Capital works deductions is up by an average of $59 per person, and the plant and equipment's up by $39 per person. So a little bit more people claiming, a little bit more claiming average, but I guess, a lot of the markets have some pretty good times through that, when a lot of investors, rush in and buy some properties when the market seems to be performing.
Yeah, you wonder if it's the more people or the more applications has got to do with more people buying property, or whether it's that people are becoming more educated about being able to do it, Brad.
Yeah, look, I guess there's always a level of combination of both. We, in our business, most of the time, outside the budget changes, grew in times when the property market was slower. So we did more depreciation schedules when there was less transactions happening in property over the years, over the 20-something years I've been here. So a lot of that was, we're doing more because we're educating more people, and they're doing it when they shouldn't, going back and back claiming when they could in the past, and now. But now sometimes it's all, but it's a combination of that and the market. I think the market of depreciation schedules that are done is probably more saturated than it was 20 years ago when I started, absolutely. But, so as time goes on and more people actually do it properly, which is great. Still a lot not doing it properly. We help those, but a combination of the two, Kevin.
What are your top tips for investors when it comes to maximising depreciation? This is a great time to be talking about it, of course.
Well, we're coming up to the end of financial year, so it's time to think about how do we get the most out of our tax returns, right? We're investors investing in property, trying to make money. We shouldn't leave it on the table at the ATO, right?
That's right.
Look, the ATO's. The first thing, don't self-assess. Don't do I think it's old, or my accountant looks after it type thing. ATO is getting a bit hefty on the scrutiny and they've come out recently a couple of times talking about scrutinising excessive claims relating to investment properties in the 18-19 years, what they'll look at heavily. Expenses on borrowing costs, owners that are renting out properties as to whether or not they're genuine holiday homes or genuinely available for rent. And look, making sure that you get it assessed properly, so you get all the deductions and you don't get audited and have sort of issues with the tax office if you do get that sort of situation. So we do lots of reports for people that are being audited, getting audited. I think I achieved the ultimate result recently when a client that was getting audited, or they weren't a client, someone was getting audited and they said, "Where'd your depreciation numbers come from?" And we said, "How'd you hear about us?" When they called us, and they said, "The ATO said call you and get one."
That's a pretty good recommendation.
That's the ultimate referral, isn't it? I feel like I've achieved.
Just don't pay them a referral fee.
No, we don't pay the referral fee. So, because we always ask, "How'd you hear about us?" And they might say, "My accountant," or whatever, or "Watch this great show today." But one said the ATO said call you.
That's fantastic. Yeah.
So so the ATO wants it done properly, and they see depreciation reports, they see BMTs. We do lots of them, so they'd see them, and it's got some basis. The quantity surveyor's involved, and so the cost estimates are accepted by the tax office. Other tips, we got stuck on that one for a while, didn't we?
It's a big one though.
Number two, I've got, look, you don't need to rent out your investment property for a full year to claim deductions. The deductions, and holiday houses are one, for example, the deductions can be prorated over the time if you rent it out for half of the year, not the full year. There's still claims available, thinking and I guess where this comes about, it's the part year firstly, but it's also the family home that gets rented out, not because you bought it as an investment property, but because you decide to move out of it, or move out of it for part of the year and go and work somewhere for 6 months or a year, somewhere else than where you normally live. These part years often mean a fair few dollars in deductions. We can do things make sure we apply the rules properly to get the maximum out of it, and often it's worth considering in that situation. One thing to be careful of in that is that you can create a property that gets affected by the budget changes from a couple of years ago. So you want to sort of check with your accountant on the way you're going to structure and when you're going to move out, or how often you're going to rent out your holiday home and those sorts of things. We help you with the numbers on what you can claim for that year, but there's obviously a few other issues around whether you do that. Mm-hmm. I've got owners of small and medium businesses taking advantage of instant asset write-off is probably the third tip. There's a few changes in that, and they've really made it, I guess, better in respect to getting more deductions to try to, and they do these sort of things to stimulate spending in the economy. A lot of the instant write-offs for small business has changed from $25,000 to $30,000, and the size of the business from $10 million to $50 million. And there's a lot of small business enterprise rules, and we prepare our schedules under those small business enterprise rules to make sure that you take advantage of those deductions properly. And the government does those things to help stimulate the economy. It's all got a little more difficult than it was, but if you're spending up to $30,000 in some businesses, it can be an instant deduction now. You want to take advantage of those ones if you've got them. And look, the last thing is we're coming up to tax time. We've got a situation where I still see so many that don't claim depreciation properly against their properties. And if you do another tax return, your back claims for previous years, you lose another one. If you've owned a property for 3, 4, 5 years or however long and you haven't claimed it properly and you're one of those that are missing out, you can go back and amend 2 years of tax returns pretty easily. If you do another tax return, that's one more that you miss. If you don't get it done soon, pre-30 June's the time that your bill's deductible. But before you put another tax return in and miss another year that you can go back and claim and fix it up, get your cash back from the ATO. It's really simple.
Yeah, and when you think that on average, the average investor's probably leaving $5,000 on the table, a couple of years, that's $10,000. That's a lot of money.
Look, most, as we've seen from the data here today, most investors aren't on the top marginal tax rate, but even at 30 or 37 cents in the dollar, $5,000 or $10,000 for the last couple of years, it's a few $1,000s in your pocket. Absolutely. It's worth the exercise to, see if you can get some money out of it. That's why we invest in property in the first place, for building wealth, right?
Indeed it is. I know you're at a very busy time of the year, or you're about to go into it, that's for sure, Brad. So thank you for...
already.
Yeah, yeah, I can imagine. Well, mate, thanks for giving us your time, and it's always a great insight. Thank you.
Kevin, great to be here as always. Thank you very much.